Hello, and welcome to the Life and Whatnot channel. Today on the Money Basics 101 series, we'll discuss 5 ways to make your money grow, the pros and cons of each investment type, and the differences between them. Now let's begin. Please note that the information in this video is for educational purposes only. Please continue to do your own research in order to find out what investment strategy is right for you and get in touch with a financial professional to discuss your options. So the last time on Money Basics, we discussed the Rule of 72. We learned that the Rule of 72 is a formula that will teach you how long it takes for your money to double given an interest rate. You'll take 72 divided by your interest rate, and the result is how long it'll take for your money to double. So what this table shows us very clearly is that the rate of return that you earn over time can really make or break your investment goals. It is crucial to earn a good rate of return, but how? In this video, we're going to look at common investment instruments and what kind of return we can yield from each of them. All right, so let's jump right into the first way to grow our money. Probably the most common and well-known investment is the bank savings account. But what does the bank savings account really offer us? Well, very little, unfortunately. Having a savings account is very easy and convenient. They're issued by banks and credit unions, and so your money is safe and considered low risk because you're not invested in the markets. You can make deposits and withdrawals very easily in a savings account, so you don't have to wait for longer processing times. In return for saving your money with them, the bank will give you a little bit of interest, usually a fraction of a percent, or in the case of a so-called high interest savings account, even 1%. But using the Rule of 72, it's pretty clear that we'll need to do better than to double our money every 72 years. I'm sure you'll agree. In some cases, the interest earned on savings accounts may not even keep pace with inflation, potentially reducing the purchasing power of your money over time. So let's see if we can do a little bit better. Next, we have GIC. GIC stands for Guaranteed Income Certificates. A GIC is a deposit investment product sold by Canadian banks and trust companies. Your funds are held for a certain length of time in return for a guaranteed interest rate. Your interest rate will depend on the term, and the longer the term, the higher the guaranteed interest. Some of the pros of the GIC are that they are a relatively safe investment product. They are issued by Canadian banks, credit unions, and because of this, they're also low risk. Your money is not in the market, so you're not experiencing the highs and the lows of the markets, the volatility of the markets. They are quite stable. You are getting a fixed rate of return for a specific term, so this means that your investment is pretty predictable. You know what you're going to get at the end of your investment term. They can be a little bit flexible in that you get to choose how long you want to invest for. So that can be for a 1 year up to a 5-year term, and you get to choose, whatever best suits your needs. There does come in some diversity into play in that you can add this to your overall portfolio alongside some riskier assets to balance out your portfolio. Now, some of the cons of the GIC, they have low returns. Right now, we're seeing 3 to 5%. Before COVID, we were seeing 1 to 3%, but interest rates have gone up. So 5% isn't too bad, but it's still very conservative. There is limited liquidity, meaning that you have low accessibility to your funds until they mature. So you typically will have to wait until your contract is over. If you chose a 3-year term, then you'd have to wait 3 years until you have access to those funds. If you would like to break that contract and withdraw those funds, I'm sure there would be a penalty just depending on which bank you're dealing with. Interest rate risk, meaning that if the market is favorable, then you're not going to be taking advantage of better rates of return. So that can mean a loss of opportunity, right? Missing out on potential to earn higher returns. So let's move on to stocks. What is a stock? Simply put, a stock is a security that represents a fractional ownership in a company. When you buy a company's stock, you're purchasing a small piece of that company called a share. So why do we like stocks? Well, number one, high returns. There really isn't any limit to the kind of growth that you can experience with a stock. Potentially, outperforming many other investment options. Ownership. We love ownership. You own a share in the company. When the company wins, you win. If you were to buy a share or a piece of your friend's shoe company, when your friend's shoe company becomes very successful, then your interest in that company will gain as well. Diversification. Spread your risk by investing in a variety of stocks. So we know that some industries are more stable than other industries. For example, some might say that the healthcare industry is a little bit more stable than the tech industry, for example. Okay, but within those industries, you're going to have many different companies. By investing in different companies, you can diversify your portfolio, you can diversify your stocks, and thereby spreading around your risk. And liquidity, stocks can be bought and sold quite easily on the market, okay? But there are some very real cons with stocks. There is a risk of loss. So once again, if you purchase a portion of your friend's shoe company and the company doesn't do well, then you will lose money. And yes, you can lose all of your money. There really aren't any protections when it comes to individual stocks. There is uncertainty built in because of that. But some things that you may not even consider, like economic conditions, political events, market sentiment, all of these can impact stock prices. Time and research. It can take a lot of time and a lot of research to decide on where to invest your money. Nobody wants to lose money. Everybody wants to earn interest, make a lot of money, of course. And so which stock is going to be the right one where we minimize our risk but maximize our growth? Well, that is a great question. And so that's where some people will spend a lot of time and research, as they should, if they will be investing in stock. You really want to know what you're doing. And so because of the ups and downs and the uncertainty in stocks, this can be an emotional roller coaster. The stock market is volatile. It's going to go up, it's going to go down. And fluctuations in the market can evoke some fear and anxiety, and understandably so. Again, no one wants to lose money. So there always is an inherent risk in investing in stocks. But on the next slide, we're going to talk about how you can invest in stocks but still minimize your risk. Okay, so hopefully you guys are still with me. I know some of these topics can be kind of confusing, but hey, if you need to stop, rewind, pause on this video, feel free to do that, because you're not going to understand everything all at one time. But with that, let's talk about one of my favorites, which is a mutual fund. A mutual fund is a group of stocks. We call that a portfolio or funds. Some of the great aspects of the mutual funds is that it's professionally managed for you. Oftentimes in investing in stocks, we want to do a lot of research, and it takes a lot of time to do that research. With mutual funds, they are professionally managed by fund managers. So you get to utilize expertise to make the fund grow. One of the other great aspects of the mutual fund is diversification. Your funds are pooled from multiple investors, and you're able to participate in a diversified portfolio, thereby reducing your risk. For example, is it riskier to give your friend $1,000 to invest in his shoe company, or is it riskier to give 10 friends $100 to invest in their each respective company? Well, it's riskier to give one friend $1,000 because if his company tanks, unfortunately, you lose your money. Whereas if you spread that risk over 10 friends, chances are not all of them will fail. Well, maybe they could, but it's at least a little bit less probable, isn't it? You do have the ability to invest in various markets and asset classes with a relatively low investment. In other words, you don't need to have a one-time investment of $10,000. You can invest in some mutual funds with a relatively low investment, some $50, some $100, maybe even $25. And lastly, liquidity. Mutual funds can be bought and sold relatively easily. There are some downsides. there are fees. Because your money is professionally managed, that shows up in our investment as a management fee, what the industry calls MER. For example, if you have an investment that earns 10% rate of return, and the MER is 2%, that means your net rate of return is 8%. The investment decisions are made by portfolio managers. Performance can vary and potentially underperform. What we need to learn how to do is understand a little bit about how the game of the market works. And once you understand the game, then you can utilize certain principles in order to play a better hand, get a little bit ahead, and kind of know what you're doing, right? Distributions may be subject to capital gains. Okay, consult your tax professional. Now let's talk about segregated funds, also known as seg funds. First is that it offers us principal protection. Segregated funds are issued by insurance companies. Because of that, they have some additional features such as a death benefit guarantee. So you will have a death benefit guarantee on the principal invested, 75% or 100%, depending on what the company offers, as well as a maturity guarantee. It ensures that you will receive a minimum percentage of your initial investment back when the investment reaches its maturity date. The guarantee protects your principal investment even if the investment value has declined over the term. So if the market performance is positive and it did really well, you will receive the higher market value instead of just the guaranteed amount at maturity. With death benefit guarantee, it ensures that upon the death of the policyholder, regardless of the market performance, a predetermined amount will be paid out to the named beneficiary. Typically, this amount is a percentage of the initial investment or the market value. This guarantee provides protection for your beneficiaries and helps ensure that your investment will not be subject to market volatility at the time of your passing. So once again, this product is sold by the insurance companies. Essentially, it's an insurance tool. And because of that, it has the added protection of insurance and the ability to offer protection in case of divorce, bankruptcy, or other financial events, and estate planning benefits. With segregated funds, they have the ability to bypass probate. The benefit can go directly to your beneficiaries. And of course, the benefit of market exposure. You have access to diversified portfolio. Now, some of the downside of seg funds, typically higher fee than the mutual fund. There are some maturity requirements. You may need to hold your investment for a longer term in order to benefit from the maturity guarantee. And that can be 10, 15 years, and you may be subject to early withdrawal penalties. But all in all, personally, I really do like the seg fund. I think it is a great option to have in any portfolio, and it does provide you with a little bit more peace of mind. That brings us to the end of the video. Some key takeaways for today. Every investment has its use. There isn't one size fits all approach. Your best bet really is to consult with a financial professional and discuss what's right for you. There are pros and cons to each investment. There's no investment that is all bad or all good. They each have their own use. And lastly, when you know better, you do better. Hopefully, this information was helpful for you today. If this is the first time you're hearing of these concepts, you won't understand everything the first time. I know I certainly did it, but these things are quite essential and I believe a key part in helping us move forward financially. If you can understand these concepts even a little bit and start putting them to use, I think that would serve you well in the long run. Well, that's all for this video. I hope you found this information helpful and hopefully you use the 5 ways to grow money to your advantage. If you liked this video, please like and subscribe for more videos on money, life, and whatnot. Until next time.